Welcome back to another video. In this video, we will be going over the options lingo. We have this section divided into two parts. We will start by going over the options terminology. We will break down some of the terms and some of the words that are used in the options trading world. Also, we will be going over the options chain, how the information is displayed, and I will also go over how to properly look at calls and puts on the options chain. Let's start by going over the options chain. So when you first open up the options chain, you will notice there are these dates. These are your expiration dates for each contract. So let's say we want to look at the 25th October 2019 contracts. Once we click on that, we will get a little drop down. Now in that drop down, there is information on calls, which are on the left side, and puts, which are on the right side. Now calls are when you are anticipating stock is going to go up, and puts are when you're anticipating stock is going to go down. So on the left side, we will have right in the calls, the bid and ask. These are our premium pricing for calls. On the right side, we have the bid and ask for the puts. Now these are the premiums for the put side. Okay, in the middle we have the strike price and the expiration. Now this expiration is going to be the expiration we decide we will be trading. So in this case, 25th October 2019. So in all these strike prices, we will see 25th October 2019. Again, for the strike prices, we will have completely different premium for each side. If we take a look on call side, for 240 contract strike price, the premium is between $2 and $2.03. And on the put side, we have $1.94 and $1.98 at the ask. Now these are the premiums if we were to trade $240 strike price. For calls, it'll be between $2 and $2.03, and for puts, it will be anywhere between $1.94 all the way to $1.98. Another information that is typically displayed on the options chain are your implied volatility. Now implied volatility is different for each expiration. I will go over this next, how this is used, but you need to have your Greeks open when you are looking at your implied volatility. So let's go over the options chain and the Greeks. So once you open up your options chain and you click on this layout section right here on the top, you have this option to view your delta, gamma, theta, and vega, which are your Greeks. Once you click on this, they will be displayed on both sides for calls on the left, puts on the right. Now, let's focus on the $240 strike price. For calls, we have 45-cent delta. So what that means is from the current trading price, which is $239.96, every $1 move, we will add 45 cents onto our premium. So every $1 move on the upside for calls, we will add 45 cents to our premium. So if we get in at $2 and the current trading price is $239.96, and now the stock makes a $1 move up, again, because calls are when we're anticipating stock to go up. Now, if the stock price is now at $240.96, if the stock price goes up to $240.96, which is a $1 move, we will add 45 cents to $2 or $2.03, and we will be making 45 cents back on each contract. For another $1 move up, we will add another 45 cents plus the gamma. So that will be 90 cents plus another 7 cents on top of that 90 cents onto our premium. Now that's how delta and gamma are calculated on the call side. If you focus on the right side now for puts and 240 strike price. Now from $239.96, and we entered the 240 strike put contract for about 194 or 198. This is telling us that every $1 move on the downside because puts are when we are anticipating stock is going to go down, we add 58 cents onto our premium. But if the stock price jumps up $1, we take out 58 cents from our premium. So let's say our premium, our stock price moves up $2. If it moves up $2, we add 58 cents 2 times plus the gamma onto our premiums. Now that is how much return we are making on each contract. Now the second thing, the third Greek that we are looking at is the theta, which is on both ends. Now theta is how much time decay is affecting our premium on both ends. So at the end of the day, on both sides, calls and puts for 240 strike price, we are going to lose 28 cents on calls and we are going to lose 17 cents on the put contract. So if you are holding a call option strike $240, at the end of the day, you have to pay the 28 cent. Now this gets deducted automatically. Let's say the stock price stays the same. The following day, you will be down 28 cents from your premium. And now the fourth Greek is called the vega. Now vega is correlated directly with your implied volatility. Now for every 1% move of implied volatility, you either add, if the implied volatility increases, the vega onto your premium. But if the implied volatility goes down 1%, you take out this number from your premium. And this gets affected on both ends, not just the calls or puts, but this gets taken out on both ends because the implied volatility right here is affecting calls and puts for the whole options chain. So this was a breakdown of your Greeks and how they are displayed on the options chain. Now let's go over the strike pricing. Now strike price is the price at which the stock may be bought or sold, also known as the exercise price or target price. So let's go back to the options chain and I'll give you an example. For example, let's say we are looking at this stock and we were holding this for quite some time. Now it is currently at $239.96. And let's say we had a contract from $230 and we were holding calls. Now, because our contract is for $230 strike, we have a call, which means we anticipate stock price was going to go up. Now we are able to go back and buy this stock at $230, profiting the difference, which is now $9.96. So when you are choosing your strike price, you can exercise at that strike price if you are not flipping the premiums. Okay, keep that in mind. Now, going back to the slides, most strikes are increments of $1, while strike prices that have a lot of liquidity, they're increments of 50 cents. Now, the smaller the increments, that means there is more liquidity. So 50 cent, you will see a lot of that increment in SPY. It is very highly traded ETF out there for options. Now, the next thing we are going to go over is something called the option moneyness. Now, the option moneyness is displayed onto our options chain. It is divided into 3 parts. We have in the money, at the money, and out of the money. So again, I'm going to go back to the options chain just to kind of show you guys how that information looks like. Now, when you look at this chart, which is your options chain, you can divide it into 4 parts, okay? Now, calls are on the left, puts are on the right. Now, you will notice that there is a purple on both sides on calls and puts, but it is a little bit on the opposite side for each side. Now, in the money for calls means that the strike pricing is below the current trading price that is as in the money. So all the strike pricing below the current trading price, it is considered to be in the money for calls. For puts, since we anticipate the stock to go down and we are bearish, everything above the current trading price, which will be $239.96, about $240, this will be considered in the money for the puts. Now, at the money, which is the second term, this is typically around the current trading price. Okay, so for both calls and puts, this will be a little bit different. For calls, we have it at $240. For puts, it is at $237.50. Now, everything outside of this area is considered out of the money. Now, I will break down what this means on the. I will break this down how this. I will break this down more for you guys as we move forward. Now, let's go over in the money. In the money for calls options, this is below the current trading price. For put options, this is above the current trading price. In the money carry intrinsic value. We will also be covering this as we move forward. Just keep this in mind so you remember that only in the money premiums carry intrinsic value. Now, as you go in the money, deeper in the money, the premiums are much more expensive. Now, let's just go back and look at this information on the options chain. If you look right here on the call side, you will see that the deeper you go in the money, the higher the bid and ask get. Same thing for puts. The deeper you go in the money, the more expensive it gets because it carries a higher intrinsic value. Again, don't worry about the term. We will go over this in a little bit. Now, the next term is at the money. Now, call and put is considered to be at the money when the strike price and stock's current trading price is the same. Now, it might not be exactly the same, but it is usually around that price range. Now, at the money is great for scalpers and day traders, and a lot of strategies such as straddles are used to be traded at the money. Premium pricing increases quick once it moves into the money. So the reason why day traders and scalpers use at the money is that their whole goal is to get that strike into the money. And the faster it gets there, the quicker your premium will move. It carries no intrinsic value. It only has extrinsic value, which is derived from implied volatility and time value. We will be going over this once we go over intrinsic and extrinsic value. Next term is out of the money. Now, call option is considered out of the money when the strike price is higher than the current trading price of stock. A put option is considered out of the money when the strike price is lower than the current trading price of the stock. All right, out of the money strikes have no intrinsic value. Keep that in mind. All at the money and out of the money do not carry intrinsic value. Out of the money premiums are derived mainly from extrinsic value and volatility. Okay, we are going to go over this in a little bit. Out of the money are great for swing traders and they are cheap. And as they move closer to at the money or into the money, the premium jumps up very, very quickly. Now, let's go over what is extrinsic and intrinsic value. Now, every option premium has two components, which is intrinsic value and extrinsic value. This is what the option premium is made up of. Now, intrinsic value might be 0 and the whole value might be just 4. So that means the premium is $4. It has no intrinsic value, only an extrinsic value. So let's break this down and understand what that means. Intrinsic value represents what buyer will receive if exercised. Okay, so when we do the formula, I will show you how that is displayed. It only carries value in the money. So intrinsic value is only there when your strike price is in the money. At the money and out of the money carry no intrinsic value. Okay, so when you're looking at the intrinsic value for calls, you take the stock price, you minus it by the strike price. it gives you your intrinsic value. Now for puts, it's the opposite. You take the put strike price, you minus it by the stock price. Now that gives us our intrinsic value. Another thing, keep in mind, it is only in the money where we have intrinsic value. Anything outside of in the money, at the money, or out of the money, it carries zero intrinsic value. Now let's go over a few examples. Let's say for calls, let's focus on calls first. The stock's price is at $100. The strike price we are looking at is at 110. Now, since the stock price is at 100 and the strike price is 110, that means it is $10 away from the current trading price, which means it is out of the money, which carries no intrinsic value, and it tells us that it is not in the money. If the stock price is $125 and the strike price we are looking at is $100, we take the stock price and we take out the strike price. And the difference is our intrinsic value. So 125 minus 100 gives us $25. And it is $25 in the money with intrinsic value. Stock trading at $150 and option strike price of $145. Once you take that number out, the difference of $5 is your intrinsic value, which is $5 in the money. For puts, again, it's the opposite way. Keep in mind, when we are trading puts, we are bearish and we anticipate the stock price to go down. So if the stock price is at $100, the put option strike price is 110. That means we are already in the money. We have an intrinsic value of $10 because we take the strike price and we minus it from the stock price, which gives us $10. If the stock price's current trading price is $125 and the option strike price we are looking at is $100, that means this is out of the money. It is not in the money and it carries no intrinsic value. If the stock price is $150, the strike price we are looking at for puts are $150, the difference is $5. That means it is in the money $5. Now let's go over the next term, which is extrinsic value. Now extrinsic value is also known as time value. It is the amount of option premium exceeding intrinsic value. It is amount being paid to the option seller. Now selling options is a completely different world. Don't get into it as you're starting out trading options. Just focus on buying for now, and as you get more advanced, that's when you can start focusing on option selling. Now higher implied volatility will have higher extrinsic value because implied volatility affects your extrinsic value of the premium. Higher extrinsic value if more time to expiration. Now, the longer you have to expiration, the more time you have for that contract. In return, you will be paying a higher premium. So let's go over a few examples of extrinsic value. Let's look at a stock price which is trading at $100. The call strike price is $80. Okay, the call premium is $22. Now that's telling us because it's $20 in the money, it has a $20 intrinsic value. And the remaining is $2. That gives us the $2 extrinsic value, which is the time value. Now if you are looking at the strike price $90 and our premium is $11, that tells us that there is a $10 intrinsic value, and extrinsic value is left with only $1. If the strike price is 110, which is out of the money, it carries no intrinsic value. Call premium is 4. That means the 4 is all from the extrinsic value or the time value. Now when we go on over to the put side, and if we're looking at the stock price of $100, again, put is when we're anticipating the stock price to go down. So if the put strike price is $120, the put premium is going to be $22. That means we are already $20 into the money, and it has a $20 intrinsic value, leaving us with a $2 extrinsic value. If the strike price is 110, It is giving us $11 premium with $10 for intrinsic value and $1 of extrinsic value. If it's $90, again, this is way out of the money for a put contract, and the premium is $4. That means there is no intrinsic value. The only thing it will carry is $4 of extrinsic value. Now, extrinsic value is where most of our out of the money contracts premiums are made up of. Now, what derives that is the change in implied volatility. So let's go over the implied volatility next. Now, volatility is basically, so let's go over volatility next. In this lesson, we will be covering historical volatility, implied volatility, and how we can use historical and implied volatility together to get a better understanding of the premiums and if any news or any new update has come for that stock. So let's go over what is volatility. Volatility is measurement of the amount of the stock price fluctuation. So there are two types of volatilities. There are historical and implied volatility. These are the two main ones we will be focusing on today. So let's start by going over the historical volatility. Historical volatility measures the past fluctuation of stock price. So from the current price, from the current day and the past, it'll tell us where the price of the stock has been. It can be used to compare with the implied volatility. We will go over a few examples towards the end. Now, here is an example. Let's say in January, and then we have December. This is a 12-month period of time. We have two stocks. We have stock A, which is highlighted in black, and then we have stock B, which is highlighted in blue. Now, both of these stocks on January open up at $100, and they move throughout the whole year, and in December, at the end of December, they close at $100. Now, historical volatility gives us an idea of how much this stock has fluctuated in the past. Now, stock A might move up or down $5. So maybe it went up to 105 and down to $95 max. That means the stock moved total of $10 for the whole year up and down. And if you are looking at stock B, so $5 move up or down. And if you look at stock B, let's say it went up to $150 and it went down to $50. Now, so the stock B made a move of $50 up or down for the whole year, which tells us that stock B was much more volatile than stock A. So this gives us a general idea of when we are trading options, which stock moves a lot and gives us a higher percentage return. Now, the next one is implied volatility. Now, as the name implies, that market implies what the volatility of the stock will be in the future. So this is market making an assumption of where the stock will be in the future. It uses a 68.2% standard deviation, and it plays a big role in Greeks of options, such as the Vega. We will get to that as well. Now, so how does implied volatility look like? Let's say a stock ABC trading at $50 has an implied volatility of 20%. Now, what is 20% of $50? That is $10. So that means we have plus or minus $10 for $50. So the chart will look something like this. This is how the graph of an implied volatility will look like. You will have your $50 mark in the middle, and you will have plus or minus on either end. So $50 plus 10 is 60, and $50 minus 10 is 40. So that means there is a 68% chance that this stock, ABC, will stay within this range. And then there is a 32% chance that it will end up outside of this range. 16% chance of it being above $60 and 16% chance of it being below $40. Now so 68% chance of stock ABC staying between $40 and $60, and 32% chance of stock ending up outside this range. Now this is how it looks like. Now we do not want to use this based on this. This does not tell us that the stock is going to hit 60 or it has a 16% chance of crossing 60, so let me buy calls. This is a non-directional indicator. It does not tell us which way the stock is headed. What we want to use it as is if the premiums of the options are expensive or relatively lower as an average. Now, IV has an impact on extrinsic value of premium. Now, when the implied volatility changes, it affects your vega. Now, change in IV correlates directly with vega, so every 1% change up or down, it affects our premium with the vega of the Greeks. Now, decrease in IV will lead to lower premiums. Now, what causes change in implied volatility? Now, there are a few factors that cause a change in implied volatility, such as major court decisions against that company, changes in traders and their trading pattern, when a stock gets upgraded or downgraded, major product releases such as a new iPhone or a new laptop, rumors or news that are stirring up. But the biggest factor that causes a change in implied volatility are the earnings, because there's a lot of indecisiveness. People are not sure of what the stock will do. So around earnings, the implied volatility is usually at its highest for the year. Now let's use historical volatility and implied volatility to kind of get an understanding of how volatility affects us. Let's say we are looking at a stock, ABC, that has implied volatility of 20%. Okay, again, implied volatility is for the future movement of the stock. And it has a 20-day historical volatility of 10%. Now that's saying that in the past, the volatility was at 10%. But all of a sudden it jumped to 20%, which is a change of 10%, which causes two things: increase in option premiums, and that means there is a news, or the market is implying that there is a larger move coming into the options for that stock. Now let's say if it's the other way around, right? Let's say we are looking at a stock that has an IV of 15% and a 20-day historical volatility of 30%. So that's showing us that before it was very high of 30%, and now all of a sudden it dropped 50%. Now 30% went from 30% to 15% implied volatility. Now that means if the market was at this point implying there was a large move, it happened, and now the volatility has dropped. Also in return, that means now we have lower premiums than previous days. Now these were your implied and historical volatility.